Hey there everyone, it's Melissa Marshall, your friendly neighborhood realtor with Next Home Center Real Estate. And I am here to talk to you about, I know everyone's favorite subject, taxes. I know it's not your favorite subject, but it is important to know how home ownership relates to taxes. But before we get into the nitty-gritty, I have a quick disclaimer. I am not a CPA. If you have specific questions about taxes, please reach out to your accountant. It's really not a one-size-fits-all. With the standard deduction increase, the benefits of mortgage, interest, and real estate tax deductions, they've really changed. The Tax Cuts and Jobs Act of 2017 really shook things up with itemizing deductions. Actually, less than 33% of taxpayers claim the mortgage interest deduction. If you're itemizing, though, if you do claim that deduction, you can focus on your real estate taxes, sales taxes, home mortgage interest, and mortgage insurance premiums. You can claim itemized deductions up to $10,000 if you're married, filing jointly, or $5,000 if you're married, filing separately. So for most taxpayers, the standard deduction is the way to go. Oh, and by the way, I'm sorry, single people. We've really got to work on our tax rules for single people. But like I was saying, for most taxpayers, the standard deduction is just the way to go. But again, that's on a case-by-case basis. Speaking of basis, this is one of my favorite things to talk about, probably because it has to do with home improvements, and I am a home improvement fanatic. I love to work on my house. In fact, the basis in my home has changed so much since we first purchased it. My case is that we purchased a foreclosure and we had to really gut it before we moved in. But let me get back to basis. So basis is the starting point for figuring a gain or loss if you decide to sell your home, or for tax purposes, for figuring depreciation. So you would figure depreciation if you use part of your home as a business, or you have a home office, or you use part of your home as a rental. You can figure depreciation and use that on your taxes. It's important to understand that the basis when you first acquire a home. So you must keep track of your adjusted basis during the period you own your home. So how do you figure basis? Well, it really depends on how you acquire your home. So if you build your home, your cost is your basis. If you were given your home as a gift, it's usually the same as the adjusted basis of the person who gave you the property. If you inherited your home, it's most likely the fair market value of when you inherited your home. The cost of your home, purchased or constructed, is the amount you paid, including any debt that you assume. Cost includes your closing costs. The following fees are examples of what can be included in the original basis of your home. Things like abstract fees, charges for installing utility services, legal fees, including fees for your title search or to prepare the sales contract, any recording fees, surveys, transfer or doc stamps, owner's title insurance, or any amount that the seller owes that you agreed to pay, such as something like back taxes or interest. Any recording or mortgage fees, or cost of improvements or repairs that you agree to in that sales transaction, and sales commissions. Those things can all be included in your basis, your initial basis for your house. Things that cannot be included in your basis are items like fire insurance premiums, any charges using utilities or other services related to the occupancy of the home if you rented the home before you actually moved in. That's not typical for it to happen, but if that happened, you cannot use those as your basis. Or if you had charges connected to acquiring or refinancing a mortgage, something like a loan assumption fee. Those things cannot be included. Also, a cost of a credit report or a fee for an appraisal that's required by the lender. Those things cannot be included in your cost. Now, while you're in your home, there are events that may take place that can change the original basis of your home. This adjusted basis is something that you should track if you ever decide to sell, and also for that depreciation if you end up using part of your home for business purposes. Record keeping is good for many things, not just your adjusted basis. Can somebody shout that out to my husband? Hey, save your receipts. Just kidding. An improvement adds to the value of your home, considerably prolongs its useful life, or adapts it to new uses. So you must add the cost of any improvements to the basis of your home, which becomes your adjusted basis. And once you do this, you cannot deduct those initial basis costs. Let me make sense of this. Improvements include things like putting in a rec room in your unfinished attic, or adding on another bathroom or a bedroom, or putting up a fence. If you put in new plumbing or wiring, or install a new roof, or pave your driveway. All of those things are improvements to your home. The amount you add to your basis for the improvements is your actual cost. So this means that it includes the cost of material and labor. You can't charge yourself for labor. That doesn't count. You can't do that. So, for example, if you decide to put up a fence and you have a surveyor come out to mark the lines where your fence is going to go, that cost of the survey is also included in the cost of the fence that goes up. All of those costs are related to that improvement, so they're included. Also include things provided by state or local entities. For example, if your street was improved or you have a new sidewalk, those things can be added to your initial basis because they increase the value of your property. Your home's adjusted basis does not include the cost of any improvements that are replaced and no longer part of your home. For example, 15 years ago, you put in wall-to-wall carpeting and your house didn't have that before, so you added it and adjusted your basis. Well, in 2023, you replaced all of the carpet with hardwood floors. So now you've got to take that carpet out, just like you did out of your house, off of your basis. And so it no longer counts. It's replaced by the hardwood floors. Does that make sense? So if you're in your home for any lengthy amount of time, chances are you have an adjusted basis because of improvements that you made. It's also important to note that improvements are different than repairs. So repairs cannot be added to your basis. Repairs include things like painting your home inside or out, or fixing your gutters or floors, or leaks or plastering that's chipping. If you replace broken window panes with something similar, then those things are all just repairs. However, repairs that are done as an extensive remodeling or restoration to your home, those things are considered improvements and you can add them to your basis. So there you have it. Pretty simple. Homeownership and taxes demystified. And I happen to have a pretty handy digital home improvement tracker that I use that I'd be happy to share with you. Just reach out and I will provide that to you. I hope you found this helpful. Please give me a thumbs up if you did, and don't forget to like and subscribe to my channel.